Welcome, class. So, today we're going to dive into a topic that sits right where accounting, law, and business strategy all meet up. We're talking about the tricky world of contingent liabilities. We're moving past the simple black and white numbers you might be used to, and we're exploring the gray areas. Those potential future problems that could seriously impact a company's financial health. This is honestly one of the most challenging, and because of that, one of the most revealing parts of financial reporting. At the very heart of accounting is this idea of faithful representation, showing things as they truly are. But how do you do that for a future that's totally uncertain? That's the huge challenge we're tackling today. How do we build a systematic, rule-based way to handle an obligation that might happen or might not? How do you put a number on a maybe? And believe me, this isn't just some textbook question. It's a real-world problem that accountants and managers wrestle with every single day. So to get us started, let's think about two really different situations. On one hand, you've got a massive multi-billion-dollar lawsuit against a big company, a huge high-stakes event that could put the whole business at risk. On the other hand, you have something like a product warranty that a company offers on millions of its products. That's a pretty routine, expected cost of doing business, right? So from an accounting point of view, what's the common thread here? What links these two totally different things? Well, the thing that ties them together is that they both represent a potential future cost, a future outflow of cash. The obligation isn't set in stone yet. Its very existence hangs on what happens in the future. For that lawsuit, the future event is the judge's verdict. For the warranty, the future event is a customer's product breaking down. But in both cases, something that happened in the past, selling the product, or the action that sparked the lawsuit, has created a present obligation that depends on a future outcome. I really love this storm cloud analogy. It's just perfect for this. See, a company's balance sheet might look fantastic today, totally sunny. But a smart analyst, someone like you are training to be, doesn't just look at what's happening now. They're always scanning the horizon for potential risks. And that's exactly what contingent liabilities are. They're those storm clouds. They're risks that everyone can see, but they haven't actually turned into real losses yet. Your job as a business professional is to learn how to spot, measure, and understand these warnings before the storm really hits. Okay, so let's get formal and put the official accounting name on this concept. These potential obligations are called contingent liabilities. And look, learning this term is way more than just memorizing a definition for your next exam. It's about really grasping a fundamental piece of accounting that's absolutely critical for understanding risk and making sure companies are being transparent. All right, let's tear this definition apart because every single word here matters. First, potential obligation. This is totally different from an actual liability, like a loan you owe the bank, where the obligation is 100% certain. A contingent liability is conditional. Second, this obligation has to come from a past event. A company can't just have a contingency for something that might happen out of the blue. The sale of the faulty product, that's a past event. An industrial accident, that's a past event. And finally, the outcome has to be settled by a future event that's pretty much outside the company's control. That combination, past event, potential future obligation, that is the very essence of a contingent liability. Now, I know what you might be thinking. This all sounds kind of subjective, like a lot of guesswork. Well, not so fast. The accounting world has created a very structured framework to handle this. There are specific rules, like ASC 450 here in the US and IAS 37 for international standards, that tell companies exactly how to identify, measure, and report these uncertainties. The whole point is to move this away from just being a manager's gut feeling to being a systematic process that can be audited and compared from one company to the next. This little flowchart here is the key to the whole decision-making process. So let's walk through it. Step 1 is the event happening. Now, step 2, the assessment, this is where the professional judgment really kicks in. The company has to look at two things. First, how likely is it that they'll lose? Under US rules, we put this into 3 buckets. Probable means it's likely to happen. Think a 70 or 80% chance or higher. Reasonably possible means the chance is more than a little, but less than likely. And remote means the chance is, well, remote. It's slight. The second thing they have to figure out is, can the amount of the loss be reasonably estimated? You don't need a perfect number, but you need a reasonable range. Okay, now for step 3, how we account for it, which totally depends on the answers from step 2. Here's the rule. If the loss is both probable and reasonably estimable, you have to record it. You book an expense on the income statement and a liability on the balance sheet. We call this accruing a liability. If the loss is just reasonably possible, you do not record it on the main statements. Instead, you have to describe it in the footnotes. This is a disclosure. And finally, if the loss is remote, you generally do nothing at all. That distinction between recognition on the statements and disclosure in the footnotes is absolutely crucial. And I want to be crystal clear here. Following these rules is not optional. It's a legal requirement. The whole idea of full disclosure is a pillar of financial reporting. Deliberately hiding or misclassifying a contingent liability, say calling something that's probable only reasonably possible, just to avoid booking an expense that would hurt your earnings, that can be and has been prosecuted as financial fraud. Just think of Enron. They used all sorts of crazy structures to hide their liabilities, and we all know how that ended. This process is absolutely essential for the integrity of our financial markets. Okay, so the theory gives us the rules of the game. But let's bring this down to earth and look at some real-world situations you're going to see out there as managers and analysts. Where do these things actually pop up in a business? Let's check out the two most common examples. These two examples are just perfect because they show the different flavors of contingencies. A lawsuit is often this big one-off event. Trying to figure out the probability requires tons of legal analysis, and guessing the potential loss can be incredibly hard, especially at the beginning. Warranty claims, though, are a totally different beast. They're a classic example of a contingency that you can manage with statistics. A company like Toyota doesn't know which specific car is going to have a problem, but based on years of historical data and all their testing, they can pretty reliably estimate that, say, 3% of the cars they sell will need warranty repairs, with an average cost of $500 each. So they can calculate an estimated warranty expense. And here's the kicker. Because of something called the matching principle, a golden rule in accounting, they have to record that expense in the same period they made the revenue from selling the cars. You can't just wait 2 years until the customer shows up for the repair. You have to book the estimated cost right away to properly match costs with the revenues they helped create. So we've covered the definition, we've covered the accounting rules, but let's wrap up with the most important question of all. Why is any of this so important for you to understand? Why did we just spend all this time on this one single topic? Because frankly, understanding contingent liabilities gives you an analytical superpower. It lets you see beneath the surface of the numbers. When a company suddenly announces a huge loss because they lost a lawsuit, the average person is shocked. But the informed analyst, the one who read the footnotes, they probably saw that risk disclosed months or even years earlier and already factored it into their analysis. It lets you tell the difference between a well-managed, conservative company that plans for its risks and a more aggressive company that's trying to make its earnings look better than they really are. It's a massive clue about the quality of a company's management. If you remember just one practical thing from today, let it be this. Read the footnotes. The single biggest mistake a new analyst makes is stopping at the main financial statements. The balance sheet tells you what a company owes today. The footnotes, that's where they tell you what they might owe tomorrow. There's usually a section called commitments and contingencies, and that's where the real juicy stories about risk and uncertainty are told. Let me put it plainly. If you haven't read the footnotes, you haven't finished your analysis. Period. So I'm leaving you with a challenge. The next time you look at a company for a class project, a future job, whatever, I want you to go find their annual 10K report. And I want you to skip right past the fancy pictures and the CEO's letter, go find the financial statements, and then go directly to the footnotes. Find that section on commitments and contingencies and ask yourself, what are the storm clouds on this company's horizon? What risks are they worried about, and how are they accounting for them? Because the ability to answer those questions, well, that's what separates someone who just reads numbers from a true financial analyst.